All right, so we just finished talking about payroll. That sets us up for compensated absences. One of the benefits of working for a company is vacation pay. You work for 1 year, you earn 6 days vacation pay. That's great policy for the employee because once you've vested, you've earned it. If you vested, even if you quit, they can't take it away. And even if you leave the company, you still get paid for those vested vacation days. Some companies even allow it to accumulate, which means instead of taking the 6 days in 1 year, you can roll it over to next year and take 12 days and take a nice long vacation. So great for the employee, but what about the employer? How does the employer recognize the liability for all those vacation days? And when does the employer recognize the salary expense? Well, with compensated absences, GAAP requires that accrual accounting be applied if certain criteria are met. So the expense of these benefits is accrued as additional compensation, additional salary expense. When? During the period that the employees earn the benefits. If certain criteria are met, and we'll go over what the criteria is, but let me give you an example. During the current year, $100,000 of benefits for compensated absences are earned by employees of X Corp. The company estimates that 20% of the benefits earned each year will not be paid. So that means they expect to pay out 80% of what's been earned, 20% will not be paid out. If that's what they expect, then at the end of that current year, an adjusting entry is needed. A debit to salary expense for $80,000, 80% of the $100,000, and then a credit to liability for compensated absences, $80,000. So what is this? This is an adjusting entry, and it's an accrual of expense. Income statement now, cash later. Income statement this year, cash next year. And like any other adjusting entry, you have an income statement account and you have a balance sheet account. Notice the income statement account is the salary expense. They're taking an additional expense for salary while they accrue a liability for compensated absences on the balance sheet. So nobody's getting paid yet, but they're taking an expense and a liability for what they fully expect that they will pay out in the next year or so. The expense, well, that goes on the income statement and that'll get closed out at the end of the year. The liability goes on the balance sheet and this year's ending balance will be next year's beginning balance for liability for compensated absences. So what if there was already a balance? Well, here's the T account, liability for compensated absences. Like any other liability, has a normal credit balance. And if the beginning balance was $400,000 and we just increased it by $80,000, then the ending balance of $480,000 is what the exam might ask you. So in a question like that, where they give you the beginning balance of the liability for compensated absences, and they tell you that you have to accrue a certain amount at year end, which we did, $80,000, because they told us 20% of the $100,000 would not likely be paid out. So we took 80% and accrued it. They could tell you in the facts the amount of benefits that were paid out for the year. And let's say that's $60,000. You'd have to know to debit the liability for compensated absences for the amount that is paid out and credit cash. And that would bring the ending balance of the liability to $420,000. Here's a question like that. They want to know how much expense is estimated and accrued for the current year. And you see that Garrett Corp's beginning balance in the liability for compensated absences account is $70,000. So go ahead and make a T account, put $70,000 on the right side because that's the beginning balance of the liability. Must be last year's ending balance. During the current year, $20,000 of additional benefits are earned, and they tell us that the company estimates that 20% of the benefits earned each year will not be paid. So that means they estimate that 80% of the benefits earned each year will be paid. Benefits paid for the current year totaled $38,000. So we're going to debit the liability for $38,000 because we're paying those benefits. But how much expense is estimated and accrued for the current year? Well, that would be the 80% of the benefits earned that are expected to be paid. So 80% of the $20,000 or $16,000 is the amount of expense estimated and accrued for the year. So the answer is $16,000, which is letter C, And let's take a closer look now at the journal entries. So one of the entries you'd have to make is for the $38,000 of benefits that were paid. And that would be a credit to cash and a debit to liability for compensated absences, because they told us in the facts that benefits paid for the current year totaled $38,000. And we already had a beginning balance of that liability, so we're reducing it by $38,000. Then the next entry would be the year-end adjustment, and that would be for $16,000 because they told us that $20,000 of additional benefits were earned and that 20% were not expected to be paid. So that means 80% are expected to be paid. So we'll accrue $16,000 of expense, answer choice C, and the journal entry for the adjustment at year end would be a debit to salary expense for $16,000 and a credit to liability for compensated absences, $16,000. And notice in the journal entry, you have one income statement account, that's the expense, and one balance sheet account, that's the credit to the liability. In the $16,000 expense, that's how we recognize the amount earned this period. That's the amount that will probably be paid, $16,000 or 80%, because they don't expect the other 20% to be paid, so we would just ignore that 20% and only accrue the 80% that's probable. We can estimate it, 80%, and it's probable, it's likely to be paid. Now, we always try to anticipate the next question. That's the I-75 difference. So what they might do from here is ask you, what is the ending liability balance? Well, if the beginning balance was $70,000 and we reduced it by $38,000 in this first entry, then we added $16,000 when we accrued the expense, that equals $48,000. $48,000 represents the expected future payment for compensated absence benefits earned through the end of the current year. So here's that question right here with the same facts. They want to know what's the ending balance of the liability for compensated absences at year end. And we would have to do everything that we've done so far in the previous question to come up with $48,000, which is answer choice C. So in a question like this on the exam, they could ask you for the current year adjustment. That would be the $16,000 salary expense, or they can ask you for the ending balance of the liability, which in this case will be $48,000. And here's the T account, the liability for compensated absences, which started with $70,000. We increased it by $16,000. We decreased it by $38,000 for the benefits paid, and that gives us the $48,000. So let's review what we know. Companies that offer vacation and holiday pay, they must include what has been incurred for the year if all four criteria are met. If the obligation is attributable to services already rendered. 2, if the rights have vested or accumulated. And we'll talk about the difference between those two terms. So GAAP requires a company to accrue for this compensated absence, recognize the expense before it's actually paid, if the payment is probable, more likely than not. And 4, the amount has to be estimable based on past history. Now, some of the terminology, vesting means employees have the right to the benefit because they worked enough days or enough years to have earned it. If rights vest, then the employer has an obligation and it's no longer contingent on continued employment. Now, the term accumulate is a little different. If the benefits accumulate, then they carry over to future periods. So that means the employee can carry over the 5 vacation days earned in year 1 to year 2 and take 10 days off in year 2 if the benefits accumulate. Probable means more likely than not that the employer will have to pay the obligation. And reasonably estimable means employer can determine an approximate amount, very similar to what we learned with contingent liabilities. Now, this topic of compensated absences, they're just as likely to ask you a theory question as a question with numbers. So if the employer has an obligation to pay employees for compensated absences, even if an employee provides no future service, rights are said to have what? So what's the term that refers to the employer's obligation to pay employees for compensated absences, even if the employee doesn't provide any future service? If the employee is fired or quits tomorrow, but the employer still has an obligation to pay employees for compensated absences, does that refer to vesting or accumulated rights or both? That means vested, right? Rights are said to have vested if they do not depend upon employees' future services. On the other hand, rights accumulate if earned, but if unused, may be carried forward to subsequent periods. Let's try this question. A liability for compensated absences should be accrued if the obligation relates to what? Read the 4 choices. Let me know what you think the answer is in the comments section. And don't forget to like and subscribe because it helps the channel out a lot. And if you need more help passing the CPA FAR exam, don't be shy about going to CPA Exam-Tutoring.com, home of the I-75 CPA review course. I'm Darius Clark, and I narrate each video that you'll find in I-75 FAR, including a lot of simulations that'll help you understand how to approach those. You've probably seen on the Facebook groups where candidates pass and then thank the I-75 course and Darius Clark. If you need a little help passing FAR, go to CPAExamTutoring.com and get yourself on I-75, the right road to passing FAR.